Since January 2020, market values of the Boeing 777-300ER have declined by an average of 12% on a fleet-weighted basis. Demand remains weak with further value reductions in the near term, as international long-haul services will probably be the last routes to see passenger recovery. How demand recovers post-COVID-19 will be defined by the secondary market opportunities for the 300ER fleet, which will be out of production by the time recovery to 2019 demand levels is likely to be seen. This could be in 2023 or later. So far, 2% of the 300ERs have transitioned into secondary markets, largely ex-Emirates into Russia with several operators. The fleet is still young, and more transitions are likely to follow in the coming years. Opportunities for further development in this region will be limited though, as Russia's market capacity is restricted. The cost of both engine overhauls and cabin reconfiguration is a big issue for passenger aircraft transitions, with just the latter costing anywhere between $15 to $25 million. In a positive secondary market development, GECAS and IAI announced the launch of the 300ER Special Freighter Conversion Program in October last year. According to GECAS, the aircraft can cover 95% of 747-400F routes, given to its payload range characteristics. Conversion cost was estimated at approximately $35 million. In July 2019, Ascend by Cirium forecast at least 70 300ER conversions for the next 2 decades, representing the opportunity to convert 9% of the current passenger fleet to cargo roles. With a high volume, the type is likely to be attractive to integrators and e-commerce cargo operators. Good maintenance condition of the airframe combined with low market value would make an aircraft attractive for a freighter transition. Other options include passenger cabin modifications to better meet market expectations. In cooperation with Boeing, Aeroflot is reconfiguring its fleet of 19 777-300ERs to enhance premium quality and service across aircraft cabins. As per Cirium's fleet analyzer, there is currently one 12-year-old ex-Jet Airways 777-300ER scheduled to be permanently withdrawn from use in December this year. And in the coming 12 to 18 months, we could also see other operators following. Should this happen, we would likely see pressure on the part-out values. We currently estimate a part-out value for the 777-300ER at $51 million, driven by the high value in the GE engines. Towards the end of the decade and through the 2030s, the values of engines will decrease as part-out numbers increase and in-service fleets diminish. A substantial proportion of the fleet is less than 7 years old, and such vintages will see significant value pressure as availability continues to grow. The 777-300ER has replacement options with a slightly smaller A350-1000 or the slightly larger 777-9. Out of 43 airlines that currently operate 300ERs, only 7 have so far secured orders for 777-9s, whilst another 7 have committed to A350-1000. Delivery of 777-9 has already been delayed to 2021, and it remains to be seen if further delays will occur due to the current crisis. The 777-300ER will remain a key player in the long-haul market in the short term, but it may take a few years to find out how demand for long-haul traffic will recover post-COVID-19 and how this translates into the requirement for the 300ERs.